rate should move. It's on the small cap index. Mid-cap index is absolutely flat. The small cap index is almost unchanged as well from yesterday's close. So it's large caps doing a little better, 0.25% each, but broader markets are finding their feet. Heat map should give you a sense of how Nifty stocks are opening up and down, and then we'll take it from there. It's bulk of it, starting higher. You've got about 5-6 names which are starting in the red at this point in time. Surabhi.
Actually, I started looking at the Eternal stock first. Let's pull up Eternal. It started lower because, after a 15% rally, some profit taking is expected. But the moment there was a little bit of a, couple of rupees of a downtick, it got bought into. That's the sense for demand, and now the stock is flattened out. Anyway, let's talk about the winners on the Nifty this morning. Nestle India, 1% higher. Bharti Airtel, about 0.7% higher. Infosys is approaching numbers with, some sense of optimism, 0.5% up on Infi. HCL Tech is also managing a little bit of a gain for what it's worth right now. There is Tata Motors, which is up and about. Bharti Airtel. Bajaj Finance is managing a 0.5% up move. Shriram Finance, 0.5% up. L&T, 0.5%. So, all of these batsmen are chipping in with only a few runs here and there. No one's scoring the sixers and the boundaries. But little runs are coming in here and there, which is how the overall Nifty tally is about 70-odd points. Reliance has stopped dragging at least after 2 days. So that's big help. 0.5% up on that stock. TCS for what it's worth, 10 rupees adding up to the board. ITC, so likewise, it's a lot of stocks chipping in with little bit here and there. And no major declines on the Nifty, at least so far this morning, which is good news for the bulls. So like I said, Hero is down, but 0.25%. No Nifty stock is down more than 0.25%. It's a good-looking Nifty screen, and everyone's chipping in with a few runs on the board. So the overall tally is about 70 points now.
Well, that's right. The stocks are in focus. I think Lodha as well as Oberoi, those large trades, it appears, I think that should have probably gone out of the way because Lodha is down close to 5%. There's a big volume out there. So, that one has probably happened. Get the chart up for you. Even Oberoi Realty, that one as well. So 4 and 5% because of those large trades on both those two names. Blue Jet, that was a stock that was down 10% yesterday. It's down another 5%. So post its numbers, remember, these are one of the stocks that in fact had a very, very big run. And now, in fact, it's coming for some serious profit taking. I'll tell you what, after yesterday's 10% cut, after today's 5% cut as well, still the stock is up 50% for the year. So it seems the street either miscalculated or it appears the stock has run way ahead of itself. So keep an eye out on that name as well. What else? JSW Infra, well, that's one of the notable winners in today's trading session. So that's doing fairly well from the broader markets itself. Godfrey Phillips, let's pull up that stock. Philip Morris came out with its set of numbers overnight. The stock actually was lower, but the commentary on the India business actually was a little bit encouraging. For the time being, the stock flattish. Volumes are a little bit higher than what we normally see. So keep an eye out on that.
SML is Zusu, by the way. Remember, we were talking about the stock yesterday as well. 5% up on SML again this morning.
I don't know if my screen, but Religare is up 10%. It's got a. I think we just put up Religare. If that is indeed the case. Yesterday, the Religare stock was up
1%.
Okay, my
just
fault.
refresher.
I don't know what my screen is showing. It's showing me 314. But
so
that's why I said maybe we'll have to just give it 2 minutes more. Credag is, we should pull that up.
It's rising now. It's rising because I think some of those credit costs and asset quality issues, at least they've not been bad. In fact, they've done well this quarter, though at the profit level you can argue, but I think there's some buying on Credag from lower levels.
Absolutely. And this is the MFI space beaten down. When will turnaround happen? Out of the lot, Credit Access has always been considered as the highest quality name, but it's also taken a bit of a battering over the last 2-3 quarters with a lot of problems starting to appear. We'll sort of address more names in just a bit. Dheeraj Agarwal is Managing Director at Ambit Investment Managers. He's with us for a quick chat. Dheeraj, good morning. Great to have you with us here. Thanks very much for your time. And just sort of kick us off with your assessment of earnings, especially from financials and outlook here. Which part of financials do you like? Because that is where you've got generally there is tailwind of, I don't know if it's helpful or not, but on the institutional side, people are bullish. People want to own financials, and everybody's got their own spots: gold finance, NBFCs, large private banks, small. So there's a fair bit here. On the other side, you also have the RBI, at least trying to prime growth here, kickstart lending in a big way. It's languishing at about 10% system wide, and they really want that to move higher. So let's just start with that space, Dheeraj.
So financials results in general are pretty decent, especially the large banks. And I mean, that space is interesting because there are no issues or negatives in that space at this point of time. So the NPL issues are very much under control. There is no credit crisis in the country. The only issue at this point of time in the financial services sector is that the loan growth, as you rightly said, or the credit growth is a little weak. It's come down to 9 or 10%. At this point of time, the market is expecting or hoping, depending upon which camp are you in, that the credit growth and the economic activity will pick up starting second quarter of this year, and more importantly, in second half of this year. Now, the great thing about a forward-looking positive expectation is that the current weakness, in some senses, does not matter, right? Because it's sort of priced in, it's expected. So the current results are pretty much in line with expectation from that point of view, that the credit growth numbers are tepid, but all other metrics are quite good. There are hopes and expectations of a credit growth and the economic activity pickup going into second quarter. That, to my mind, is the most crucial variable which will determine whether the rally continues or stalls. But it's, I think, a few months away for that judgment call.
Dheeraj, hi, morning. I'm just going back to a conversation we were having with Drew Pettit, who's the strategist for Citi. And as we all know, Citi has just downgraded India recently, right? Yeah. He made a very strong argument because on one side you have foreigners who are saying India is not expensive, earnings are all right, just about okay. You've got other markets like South Korea, China looking better. So they're allocating money there, they're selling here. And then you have, of course, the Indian market because of the domestic flows being strong, that SIP book being very strong. I mean, India, I don't know when India will ever be cheap because there's so much of local money buying Indian stocks. Yeah. So then we're in a bit of a funk, aren't we? Because the FPIs are selling, domestics keep buying, and we remain in a range. I mean, how long do you think this will last?
Yeah, so the FPIs will come back in only when earnings growth accelerates. So, whichever way you actually cut it, the current expectation which the market has that from September quarter, we will start seeing inflection point for earnings growth to start picking up, and second quarter will gather pace, are the most crucial variables which will determine whether the rally continues or not. So at this point of time, you're right. There's a tussle. If you look at the last 12-month performance, right? I mean, US S&P 500 is up, I think, 13 or 14%. Nasdaq is up 13. India Nifty is up just 2% in US dollar terms in the last 12 months. Germany, Korea, Taiwan, even UK has done better than India. So what you're saying is absolutely correct. And for accelerated move in our market, we need FPIs too, in addition to the domestic money. And that, to my mind, will chase earnings. And for that, we might have to wait till September quarter.
I was just thinking, folks, we haven't used the word melt up in such a long time, right? Prashant, when was the last time you used melt up to describe the Indian market? For old time's sake, at least it should come back, no? I mean, that phase or that sense of absolute golden euphoria. But I think we're still waiting for it now.
Well, that's right. Hi, Dheeraj. Good morning. I want to ask you about a stock. You want to guess which one?
Yeah, of course. It's done very well in the last 3 days.
Is it done and dusted, though?
No, I don't.
Do you think bulk of it is in the price? By the way, I mean,
for
those who are not...
Which stock are you talking about?
It's Zomato Eternal. We have been talking about it from 100, 120, 150, 200 rupees, 300. So it's not just for the, for clients now. As a customer, you're not going to be only happy. Shareholders as well who got in, they'll be very happy. Tell us what's the outlook from here on?
So our team is still very confident on the stock, and it's one of the core holdings in one of our flagship portfolios in asset management. We still believe that the hyper growth journey for this company continues. The market leadership position continues. People keep on getting worried a little bit every time some new player or even an existing player launches the quick commerce business, saying competition is heating up in the space. But I think by now, leadership is very well established. So even if some competitor and some other players come in, it probably will compete versus each other and not really threaten the numero position for this company. So till such time the hypergrowth continues, and for that there is a long journey. I don't think there is one should be in any rush to change the view on this one.
Almost 3 lakh crores in market cap, Dheeraj.
Interesting, very interesting. It's larger than a number of very well-established old economy stocks now. But that's the way the world is moving. Look at the all the mega caps in the US. I mean, they're all sort of new economy players.
Yeah, absolutely, and we'll see what this goes. But such divergent views on this one, right? But I think more and more people are sort of throwing in saying, well, must have this one because it's done well, and gains get more gains in that sense. What about Dheeraj? What else? I mean, Paytm, any thoughts?
I don't have a very clear view on this one, but just browsing through the results which came in last evening, it seems very encouraging. But I don't have any concrete view on this one.
Okay. So, Dheeraj, what else? I mean, we've discussed Zomato. Where else? This market is so hungry for growth ideas, right? Look what happened. Ixigo, the Lee Travenues Tech, that stock Ixigo, they reported numbers and growth was good. That stock went up, 20% in a matter of 2 days after numbers. And that's the thing. There's such appetite, such hunger for growth stocks. Do you see anything else on the horizon? The wire and cable guys, for instance, they've done well this quarter. What else are you keeping on your radar?
So, the reason for that at a slightly higher level is something which I mentioned on the channel the last time I came here as well, that earnings are getting very, very polarized. This is a very different phenomenon from, let's say, FY22 to 24, where earnings was more widespread in the sense that a larger group of companies, a larger number of companies were able to deliver growth. And as the economy has slowed down a little bit, there's a risk that global economy will also slow down, looking at everything which is happening in the world right now, either on the trade front or geopolitics front going into next year. A very small bunch of companies will actually deliver growth. So this environment will end up becoming sort of similar to what we saw between 2015 to 20, where only a handful of companies were able to deliver strong earnings growth, and the entire pool of money just kept on chasing the same stocks, and the valuations became astronomically high. So I see a repeat of that over the next 3 years. I think widespread earnings growth environment is over for the time being. And like the couple of names that we discussed right now, we will have to hunt for few individual names where earnings growth is actually fantastic and the quality of earnings is good. We have to beat the market.
But Dheeraj, that's precisely what I'm asking you. That's why I'm asking you. Give us some more names, some more clues at least, because it's not easy to make money in this market anymore. So help us out here.
Yeah, I mean, I generally prefer to avoid giving names, as you know, right? So
okay, clues at least, sectors, clues,
in fact, sectors. You'll find winners in all the sectors. So like we started the discussion with financial services. So a few of the large private sector banks are clear winners out there. The quality of earnings is good. Valuations are not that stretched. There is a fair bit of logic to say credit growth and economic activity will pick up in the second half of this year. So that's one very, very clear space. Very select consumer discretionary names, if demand does come back in the economy, buoyed both by interest rate cuts as well as the tax benefit which was given in the last budget, which will now trickle into the hands of the consumers starting this quarter. There'll be winners in that space. I mean, Eternal is one such example, which is benefiting both from a micro as well as a macro tailwind out there. So you could find winners in these spaces. Some financial services, specific consumer discretionary, autos, very, very worth watching very, very closely. Demand has been weak for a very long time. Let's see if the interest rate cuts spur a demand growth back into autos as well.
Okay, all right. Dheeraj, not letting out names, but one space that has been disappointing is old tech. The earlier darlings of the market. Now today, all eyes on Infosys, because from the large cap names that will at least grow, and in all probability we'll see a revision in their guidance. How are you placed out there? Because my director is going to pull up a chart. It's actually underperformed even the Nifty. Your take.
I'm still slightly cautious on this space. And again, when I say cautious, I'm saying broad brush cautious that there could be individual names which could shine in the space as well. The reason being, I think everything which is happening in the US Whether there's a deep slowdown or a shallow slowdown is the only debate in my mind, but there has to be some deceleration in the economic activity and growth in the US going forward. It's not possible that with so much of trade barriers, tariff controls, XYZ, and the other, growth can actually accelerate. So IT space being directly sensitive to what happens in the US and US economy could actually be in a slow growth zone for another year and a half. So I just continue to be cautious.
By the way, Nigel, Infosys will report, but so will Coforge.
That's a stunner.
That's the one to watch out for. Coforge stock should come up on your screen. Out of the pack, IT pack, I mean, just look at expectations.
Yeah.
This is the one which I think has got highest growth expectations. In last few quarters, I mean, it has actually beaten what the street has said. So just keep an eye on this.
And just to close the loop on Eternal, in terms of market capitalization, 3 lakh crore and the 28th most valuable company on the BSE, the top 100 market capitalization company. So what a journey out there.
I think Coforge, I would rank as probably all last 3-4 quarters, the strongest management commentary on the street. I think the only one that comes close today is the management of Schloss, Bangalore, Leela Hotel, sounding as confident about their business, 400 crores in profits this year. But anyway, these are the kind of stories that the market is really, really hungry for and willing to reward. Dheeraj, thanks very much for the conversation today. Great chatting with you as always. Wish you a good day and we look forward to connecting again soon. Okay, let's stay with the earnings. Markets holding up, actually. Markets been pretty okay so far, though the Midcap index is flashing some red, so watch for that. Nifty still holding on to a 50-point gain, but Midcaps are a little cautious. Now, we're staying with earnings and putting the spotlight on KEI Industries, and it's been a good quarter for KEI, especially their wires and cables business, because overall revenue is up in the 20s, but if you look at the wires and cables part of their business, then that has surged 32%. Margins are in line with street estimates, though, there's a little bit of a pressure that's coming over there. So let's discuss all of this and more with Mr. Gupta, who's with us now. Sir, great to have you back on. And another solid quarter. We're just discussing this with our market guests that I think wires and cables at least is one segment where the market keeps getting growth. And you've done so well, right? You're best in class, 32% growth. Now, just tell us, what does this reflect? How does this reflect on your full year projections? Because your first quarter has been so solid. Would you like to increase your full year guidance, overall revenue guidance, or maybe the wire and cables guidance?
Yeah, good morning. We will still be very cautious. I think we will continue with our guidance of 18 to 20%, although we will definitely try to aim better. The first quarter has been extremely good. We have grown our export of wires and cables by 122% compared to last year. It is the actual growth is 61%, but it is due to decline in the export of EPC project, which was there last year, but now it is not there. But the wire and cable growth is substantial.
On EPC, can you just tell us, that business has been weak. So the revenue is down 56%. EPC margins also under a bit of pressure. So what's happening there? Can you just specify and give us some numerical guidance as well on if it picks up in Q2, Q3?
No, the EPC business we are consciously bringing down. We are not taking new projects, and our aim is to limit it to maximum 3 to 4% of our total sales. So this has been a conscious decision 4 years taken back 4 years back. And we are consciously closing the contracts and bringing down the business as we are not taking new orders.
And by when will you get to that? This reorganization or this shift in focus, more on wire and cables. By when will you reduce EPC to 4%? So this whole exercise will be complete, just so that we know.
We have already reduced it to that level. So we want to keep it maximum within 400 to 500 crore level a year.
Okay.
Mr. Gupta, you continue to beat what you say you will do. Good morning. 18 to 20% though revenue growth is maintained, but 25% growth this quarter. So, and you're saying you're confident of maintaining growth rates. The big, at a high level, the concern broadly for the sector is the simple question: have margins in the wire and cable segment peaked? Will there be pricing pressure because what new competition is doing in terms of setting up capacity over the next, it's already underway. and will go on over the next 2 or 3 years. And that's a lot of new capacity, some 75 to 80,000 crores being put in. Will that cap what margins you can make in wires and cables, and have margins which are healthy? Have they peaked here?
Prashant, first of all, I think from where this figure of 75,000 crore capex comes, I don't know, because that much of capex has not been planned even in totality by most all the companies. Secondly, the whatever capex will come, maybe 8 to 10,000 crore in next 2-3 years. Market is also growing, and I think there will be enough room. I think we will be seeing more growth in this business because government capex is growing, and I think private capex will also come up strongly. So there will be enough room for the growth for everyone. Our focus will remain on domestic market as well as export market. I continue to maintain my guidance that we want to take our export to 20% of our total sales within next 2 to 3 years as our new capacities comes on board, which is coming up by mid of this year and then by the next year.
So you say revenues will grow. There is absolutely no doubt. The market itself is growing. So it will get absorbed. All this will get absorbed. But even on margins, you're saying, I mean, there's no reason to imagine that there is a cap.
No, I don't think. And I think we have given a guidance of around 11% EBITDA margins. We'll definitely try to improve it by 0.5% to 1% as our economies of scale comes up, new capacities comes up. We are more established in Western markets. So we will definitely aim to grow the margins. But as of now, I will still maintain a EBITDA of 11%. For next 2 years.
All right. Hi, Mr. Gupta. Good morning. And the numbers look fairly okay. The wires and cables business, if I compare you with your peers, whether it's with Polycab or with Havells as well, in revenue terms, you have actually outgrown them. Margins are relatively lower. My question to you is, are you outpacing industry growth, and have you gained market share in the wires and cables business?
I think you must have seen that our export of wire and cables has grown by 122%. It is more than doubled compared to last quarter. That is the reason that we have outgrown the industry peers in our revenue.
All right. So in the domestic market, actually, your market share will be more or less stagnant. Is that correct?
Yes.
All right. Do you have a number handy as per your calculations?
No, I don't have immediately handy numbers.
Okay, all right. Could you tell us, going ahead, what kind of a capex outlook are you looking to put out at current utilization levels? What is it? And give us a sense about how you plan on adding capacity.
This year, we expect to spend around 900 to 1,000 crore capex in our Sanand plant. And the next year, again, this capex can be 600 to 700 crore. Because by the time we complete the project, we will be also doing another capex in the other lands which we have acquired, and it may be for the increase in the capacities of existing products or for some backward integration as well.
Mr. Gupta, I just want to come back to that margin point. And interesting to note that you're sticking to your guidance of touching the 11% EBITDA margin mark this year. And that'll be interesting because the last couple of years, the margin has been hovering between 10, 10.5. I think the last it was above 11% was around FY21. So just give us some more color. What is the kind of price hike that you will plan to take, if any? I think there was one taken towards the end of the previous quarter. Will there be need for more price hikes? And also, since you're going to grow your export business to 20%, how do the margins compare between the domestic business here and your exports?
In exports, the margins are slightly better. That is why I say that we will be able to improve our margins. Secondly, as we start our Sanand plant, we will have some improvement in the margins because of the logistic costs on imports and exports, and also on the incoming raw materials. Because many of the raw materials are procured from Gujarat, or many of the raw materials are coming through imports. So our inward freight cost and outward freight will be lesser, which will definitely improve some bit of our margins.
Okay. All right, Mr. Gupta, we'll leave it there. Thank you very much for joining us. Good speaking with you, sir. And appreciate your time here. Good luck. So, I mean, margins, keeping it at about 11% is the aim. But, you know, Mr. Gupta did say we'll aim to improve those EBITDA margins by between 0.5% to 1% or so. So interesting chat there. Nigel.
Just one more point I want to make, from the broader market, so the headline index is a little bit nervous and the mid-cap index has moved to the low point of the day. Bombay Dyeing was a stock that we had highlighted, a week or so, that we're seeing very, very large delivery-based buying out there. The volumes this morning are massive, it's, I think, more than 50 lakh shares out there and the stock is flying away. We'll try to check out more, but we had highlighted that the stock was moving on very, very large volumes and very, very high delivery-based buying. For the time being, shooting up more than 8% as we speak. So just thought I'll highlight that one.
Absolutely. So just a few names, right? I mean, there are some reversals happening, as Nigel said. Market breadth is turned. About 1,450 stocks are lower and about 1,024 stocks are higher right now. Lodha, of course, block we highlighted. Paytm is down 2%. And there is Oberoi Realty down 3.5%. Tilak Nagar, which went up like a rocket yesterday, is down about 4%. Blue Jet has been, again, I mean, yesterday was a sharp cut. Blue Jet is down another 3.5% right now. PNB Housing, Patanjali, M&M Finance, Iron Exchange is another, I mean, it's a water treatment company. It's down 9%. And it's got decent sized volumes, by the way, about 491 on Iron Exchange. I mean, I hardly ever remember mentioning this name, but it's got volume. So just making a quick mention of it. Let's welcome in our next management. Dixon reported numbers yesterday. First quarter performance was in line with expectations. Revenues are up 95%, jump driven by the mobile segment. Now, the share of mobile as a percentage of the overall pie has increased quite a bit. Saurabh Gupta is Chief Financial Officer at Dixon, joining us now. Saurabh, good to have you with us here. Thank you very much for joining us. So, just the basics out of the way, based on what you've reported for the first quarter, right at the outset, what visibility do you have for the full year FY26, Saurabh, in terms of revenue growth?
So, Prashant, I was always expecting this question from you. Yeah, so my sense is, the quarter two the order book for quarter two looks very healthy, and it's also the festive season, ahead of the festive season. We feel confident, Prashant, that at least a 45% kind of a growth is definitely doable. Yeah, there can be growth, can be marginally lower and higher than that, but broadly 40-45% is something that we are targeting for this financial year.
And margins, Saurabh?
Margins this year, Prashant, should be on a similar levels as last year. But we expect as and when our component foray, the components come into the system, then the margin expansion will start to happen. But this year, the margin should be almost similar to last year.
Okay. So same margins like last year and about 40-45% revenue growth for the full year.
That's right. That's right.
All right, got that. Within the revenue pie, Saurabh, hi, morning. Can you give us, by the end of this year, what will the breakup look like? Obviously, mobiles is a huge segment of it, especially this quarter, because you keep executing these large contracts. But then the laptop business is also coming along, the other, personal devices business. So by end of the current year, what will the revenue mix look like?
So we still large part of a contribution will come from mobile this year. I think so. Laptop will start making meaningful contribution only next couple of years. This year it will be a smaller number for laptops as we are ramping up. We are expanding in a Chennai plant, and also our JV with Inventec will only come up by Q4 or Q1 of next financial year. So my sense is those numbers. So large part of contribution will still be coming from mobiles. That's where we have the largest opportunity this year, and followed by telecom, I would say.
Okay, and what about segments like lighting, other appliances? I'm just trying to get a rough revenue pie mix, in a percentage sense. Should we assume that 90% will still be mobiles?
Almost 80% will be mobiles, 75 to 80%. The way we report is mobile and other EMS division, which also includes your IT hardware, also includes your telecom. So telecom vertical for us will be closer to 5,000 odd crores, which will be broadly 9 to 10% of our revenues. And yeah, but mobile will be the largest contributor. Lighting, yeah, our JV with Signify should be operational in the first week of August. So once the JV is operational, we expect to get more product categories from Signify for the Philips brand. Gradually and slowly, we'll keep getting some export opportunities there. So yes, the lighting revenue should see an uptake. Our refrigerator revenue should see a significant uptake this year because we are expanding our capacity in direct cool and also adding more product categories. So that will also start making meaningful contribution in the next couple of years. But mobile will be the largest piece for us this year.
So FI, all this washing machines, telecom, lighting, IT hardware, all basically starts to show up in size FY27 beyond.
FY27 and beyond, right? Absolutely, Prashant.
On electronic components, we've spoken about this quite a bit and how that kind of helps you improve margins. Have you that subsidy scheme? What's the status?
Yes, so subsidy scheme, we expect to file our applications under the ECMS category. The deadline is July 31st. So we have already signed up the JVs on the display side, on the camera module side, on the mechanical side, on the precision component side. So we'll be filing our applications in the next 7-10 days before the deadline of 31st of July. And then, yes, the camera module, since it's an Indian acquisition, Indian company which is already operating in India. So we plan to close the definitive agreements in the next couple of months and hopefully start consolidating by Q3. As far as the precision components, mechanicals and metal parts is concerned, it will require the Press Note 3 approval, which should take another 6-7 months. So hopefully the number should start reflecting by next financial year. And our display, the construction is underway right now. And the mass production should happen only by Q1 of next financial year. So next financial year, we're expecting at least a 120, 130 bips margin expansion, net of the PLI impact that will go away. And by 27-28, there'll be further ramp up and stabilization of all these components. So I think so the margin expansion can be slightly better in FY 27-28.
Okay, Saurabh, we haven't, I mean, it's been a while. We haven't spoken about the semiconductor plans, I mean, and the facility that you were looking to set up in Noida under the semiconductor mission. Can you update us on what's happening there and, how much money you've committed as of now?
So, Survi, we are still awaiting for that ISM2 approval of the government, which, of course, has still not yet come in. So we have already tied up with HKC for the display modules, and getting into a fab with them will be a natural extension for us. But we'll wait for the guidelines because since it's a large capex, we would need that support from the government, both from the central government and the state government. So if 70-75% of the capex as part of the policy guideline is committed by the government, then we'll be between both our partners, us and the HKC, will be willing to put in the balance 25%. So we are still awaiting for that approval. My sense is it will take some more time, I would say, for the government.
Is it right? I mean, there were some numbers floating that this could involve, this facility, including the fab, could involve a capex of 3 billion. Is that right? So, and you're hoping that the government kind of pitches in with 75% of that?
That's right. That's right. So 3 billion and our outflow would be 750 million. And within that, the partner should put in, say, 1/4 of that. So Dixon's outflow should be 500 million, which should happen over a period of 3 years because this is a large, big gestation project. This will take a couple of years to 2-3 years to come in, which we feel confident seeing the balance sheet and seeing the earnings visibility that we have and the growth that we have. We feel confident that can be funded from the internal accruals. And even if some debt is required, our debt to equity is hardly there. It's almost negligible. So we can always take some little bit of debt, but large part of it can be funded from internal accruals. But that can add a significant more to our business because that is not only for mobiles, that is also for notebooks, that is also for LED TVs, and also for automotive displays. So automotive displays is also something that we will be getting into very shortly in the next couple of years.
Sorry, Saurabh, the fab is that you're talking about, that is for what?
So fab is so as of now, Prashant, we're getting into the display modules.
I see.
Which is part of the component PLI, which is again with HKC. Fab is another one level more extension by getting into the display, absolutely display manufacturing, which would include the semiconductors and the other deepened manufacturing process. So HKC has a fab in China. So if the government comes out with a policy on ISM2 with a committed budgetary outlay, then we will look into get into that.
ISM1, I think there were four awarded, right? 4 companies were given.
Yeah, it was given to Tata, CG Power, and I think so Keynes.
Keynes was one, and there was one more.
That's right.
But But under that, there is no. I thought there was some more which got spilled over, and there are still limits left out of what the government said it wanted to
I think so.
allocate.
The budget was exhausted, Prashant. That was a $10 billion commitment from the government that was exhausted. So we are hoping that another ISM2 should come in, because any semiconductor or display is a very critical component which goes into any electronic product. So of course our play will be more into the display fab. So let's wait from the government to come that, and then we will finalize our plans on that side.
Okay, just one thing just to go back to the phones, basic bread and butter. What percentage of what you make here is exported, Saurabh?
So this year exports will ramp up significantly. Last year we were at 1,700 odd crores out of 39,000 odd crores. This year we hope to do an export of closer to 7 to 8, anywhere between 7 to 9,000 odd crores. The first quarter number is already 1,700 odd crores. And one, of course, for our anchor customer to US markets, where clearly there's a big arbitrage now. And secondly, for another customer, which is also our partner, we are working on a large export order to Africa markets. So let's see.
So just to again, since percentages help us understand this very simply, exports as a percentage of your total revenue this year would be how much? And exports to US as a percentage of the pie would be how much this year, Saurabh?
Yeah, so large part of this 9,000 crores will be for US Surbi. A small part will be for the other brand for the Africa markets. But we see that number growing in the coming years. So all put together, my sense is if last year that number was 5% of our revenues, this year broadly that number can be 14-15% of our revenues, if not more.
Okay. By the way, you're also doing a joint venture with in your telecom business. Apparently, that's something you mentioned something in the call for again some high-end perhaps a tech collaboration. Can you just give us some more details there?
So Surbi, those details are still in the works right now, and I'll be able to share that. But yes, it will be for another electronic component, which is part of this electronic component scheme. So yes, hopefully you should hear some more announcement from us on the telecom side. It is a component which goes into data centers as well as for telecom products. So we are working with a company which is very big into that and has a very good technology on that.
And Saurabh, I'm sorry, back and forth, I forgot one point since we were talking exports. Now, especially with your US client, we still don't have final contours of a deal. If you look at our regional markets here, so between 15% Japan, some are at 20%, South Korea is at 25%. Now, if the final tariff for India ranges somewhere in this vicinity, if it's more than 10%, 15 or 20 or whatever, I mean, how does that impact you, or is it all completely built into the deal with your US client? I mean, does it impact the offtake in any way?
So Surbi, I think so more than Japan, I think so we should look at manufacturing nations which are manufacturing mobiles, which is majorly China and Vietnam for us. So China, we feel confident that there will always be a decent arbitrage, and like the way it is today, and hopefully it should remain that even if the deal is not closed with India today. And the other is Vietnam. Vietnam deal is already announced. So let's hope that our numbers with Vietnam should be lower. Yeah, so that's we are hoping for.
Okay. Just one last question, Saurabh. Rare earths, any impact? Restriction on rare earth?
Not specifically in mobiles or per se, but yes, it has some kind of impact in our variables business, but there are alternatives being worked out. So not a big impact for us as of now.
Okay. All right. Saurabh, good discussion. I think we covered a lot of ground, and thanks very much for all the details. Appreciate it. Good luck. That's Saurabh with Dixon Technologies with some perspective. Markets, by the way, are down about 35 points. Just look at Idea Forge, another name which is seeing a bit of a crack now. So Idea Forge is down about 6% at this point in time. Tejas Network is down about 3%. Actually, in the mid-cap side, there's a lot of stuff which is moving. I mentioned Ion Exchange. Volumes are large on this one. I will check if there was earnings or something else. Oberoi Realty is down about 3.5%. India Cements is down about 3% or so. Raymond is down about 2.5%. Jana Small Finance Bank is another one. I think it's down 6% at this point in time. Kajaria is down about 3%. And these are all large liquid names which are seeing some activity as things stand right now. On the way up, if I can spot any outliers, Nigel mentioned Bombay Dyeing, which is up 9%. Anthem is up, the recent listing, 30% pop on day one. It's up another 3.5%. It's got very large volumes on it. Credit Access, of course, we mentioned. Sapphire Foods is up 5% at this point. There's a stock called Infobean. It's just coming up with very large volumes. 533, stocks up 19%. Not Infobean, ends with an N.
I didn't know that existed. I thought you were talking about Infobeam, Prashant.
I don't think we have it, but it's showing up. But I think it's the 6th or 7th largest volume traded name on the NSE. So yeah, things are popping all over the place. Leela, we just had the management with us, about 2.25% higher. Godrej Agro is up about 3%. So yeah, there is a lot of action, a lot of
Sapphire is running very, very hard.
Sapphire is up.
Sapphire is up 5%. You have Anthem Bio as well. It's given you a big listing pop and it's building onto those gains as well. So massive move out there. And we were talking about the refiners a couple of days ago. MRPL, the numbers look very, very disappointing. But it seems, the street liked what they had to say in their con call. And that's why, actually the stock is now above what it was prior to the earnings. So it's recovered all of those losses, and CPCL is the one that we'll watch out for in terms of their numbers in the coming days. So we'll keep an eye out on that name. For the time being, it's down 1.5%.
Nigel, Hormuz has spotted that stock for us. We'll get it added. It's Infobeans, right? Ends with an N again. 2.5 lakh shares traded, and that's why I spotted it. 20-day average is 600 shares, and that's why it came up on my screen. That's the one I'm talking about. 600 average and 2.5 lakh shares today. It's a software development company, Hormuz tells me. So we'll have more on this one in Hormuz's unusual mover segment a little later in the day. But it's a pretty vibrant screen with enough up and down as well. Market breadth, though, is slightly negative. We take a quick break here. Mitesh Thakkar joins us on the other side.
Welcome back. Well, the market's still holding with a gain of close to around 50 points. However, the mid-caps are doing a relative underperformance in today's trading session. Let's get in Mitesh Thakkar to help us out with his take on the markets. Mitesh, I don't know whether you've observed, but Bombay Dyeing, that stock is now up 10%. There's a massive move that we're seeing on that particular counter. Very, very high volumes on that name. There are close to 2 crore shares that are traded in 1 hour of trade. Anything you're looking at on the charts? I highlighted a few days ago that there was massive delivery-based buying on this name.
Nigel, you're right. I think This is one stock which has given a breakout on short-term as well as medium-term charts. The minimum target I'm looking at is about 190, 195 zones, but logically, I think the stock could even head towards 220 plus. So extremely positive over here on the medium-term chart basis. Slowly accumulated because the stock has already moved up today. But yeah, I think, traders should look to get into this. And as long as the stock is above 165, 164, good chance that we'll eventually see 220 over the next few weeks, maybe a couple of months.
Okay, got it. Quick word then on the markets as well, the Nifty price action, and give us your couple of stocks as well.
Nifty, nothing much. We've had a opening and then we've been kind of very flat. And I've said this that, we are most likely doing a range of about 25,300 to about 24,900. So we're still in the middle of the range. But Bajaj Finance is something, which comes on my list. It was a buy a few days back as well. Good setup over here in terms of hourly and 2 hourly charts. So keep a stop at 950, look for targets of 990 plus. And a lot of real estate names have broken down. Today we are seeing some negative movement in Lodha, DLF, as well as Prestige Estate. So Lodha Developers, which is Macrotech, despite the fact it's down 5%, slowly shorts can be taken with a stop about 1380 and a target of 1300 is what I'm looking at.
Okay, all right, great. Thanks a lot for that, Mitesh. Well, let's focus on SBI then. They raised 25,000 crores by India's largest QIP. Our colleague Yash Jain caught up with the SBI chairman, Mr. Sethi, and asked him about how will these funds be deployed. Let's listen in to what he had to say.
We always had adequate CRAR, the capital ratio, which helped us to achieve the credit growth. Maybe, we were saying 6 to 7 lakh crore credit growth could have been supported without raising this capital. But this augments our common equity tier 1 capital. So the CET1, as you know, will improve up to 11.5%. Our end objective is to take the CET1 to 12%. And also the CRAR increases to 14.9%. And probably we will have 15% CRAR through the cycles. Correct. Which means that these two capital ratios, while not very significant from the credit growth point of view, but will definitely provide the confidence to the system, investors, regulators. This is the purpose of that.
The second question, sir, the major investors which come through this?
I think there's very diversified investors. Obviously, there has been a good demand from the overseas investor, and that shows the confidence in the Indian economy and SBI in particular. Very diversified customer base, and of course, there's been a good demand from the local AMCs, DIIs, what we call. I think it has been a very diversified one.
Okay, second question, sir. As far as the 25,000 crore is concerned, now the need to value unlock some of your subsidiaries, SBI Mutual Fund, SBI General, does that go out of the window at least for the next 1 year? And what happens to the deal with Yes Bank?
So we did mention earlier that our various components which we have, it could be S Bank or NSE or subsidiaries, all these are still on the table. Nothing is off the table. Our end objective is to further strengthen the CET1 capital, and we will use all the components at the appropriate time.
Okay, all right. Well, let's focus then on some stocks on the move. Dalmia Bharat, well, that's reacting to its Q1 performance. And at the start of today, we said that the numbers were good. But now that surprise element actually is missing. And the stock in the last 1 month or so, today it's coming for profit taking. Pull up a 1 month chart. The stock actually has seen a big rise of more than 10%, even after this 2% pullback. And it was closer to around a 52-week high. The numbers look fairly okay. Top line was a small miss. The EBITDA number actually was better. What played out here? If you pull up the EBITDA per ton, it came in at around 1,261 rupees, which is a sharp improvement both on a sequential basis as well as on a year-on-year basis. The problem was on volumes. They have degrown by close to 5%. That's, even if you exclude the JP volumes, which was at around 0.4 million tons, then as well, the number is more or less flattish. So no volume growth is something that the street will be disappointed on, because that means they're losing market share. Though on the realization parameter, there was a positive surprise. Since they have a fair bit of exposure to South India, realizations went up by close to around 9%. Their longer-term time horizon is good. Currently they're at around 50 million tons. They laid out a plan to get to the mid-60 million tons or thereabouts with the plan that they've raised. They've already announced a capex as well at roughly around $65 on a per ton basis. And the capex spend that they've earmarked is close to around 3,000 crores for a 6 million ton capacity with a 3.5 million ton clinker capacity as well. So the trajectory is good. They're going to be becoming a larger size cement player by 2028 when they're saying they're going to be a 75 million ton unit. However, lack of volume growth seems to be plaguing the street, and lack of a positive surprise as well is the reason that the stock is coming for profit taking, because the street sniffed it, had already run up in anticipation to these numbers. That's about Dalmia Bharat. I'll tell you what, we'll slip into a short break, but Manisha is waiting for us on the other side. She'll tell us all that's going on in the commodity space.
Welcome back. Well, let's shift the focus now to the commodity markets. As promised, we have Manisha joining in with the latest. Manisha, good morning. So what are you tracking today?
Oh, it's a silver lining to silver, really, because we've seen very strong gains come in for this one. Silver actually is outperforming gold when you look at the last 1 month or YTD numbers as well. There you have it on your screens. So in last 1 month, we've seen gold prices gain up by 3%. Silver is up by 9%. In this year now, silver clearly is taken over on gold. With 32% of gold gains, we've seen silver gain up by 36% there. So when you look at the gold prices, we did see an all-time high in this year, in the first quarter itself. And even at this point in time, gold is trading at around 5-week highs into the markets. When you look at the gold prices, we're just about $60 away from that all-time high of around $3,500 an ounce. We seem to have slipped slightly more from those kind of levels. But when it comes to silver, well, we are trading at a 14-year highs in the international markets, and for the Indian markets, it's an all-time high at around 1,16,000 rupees a kg there. Well, a lot of supportive factors onto this one. To begin with, China has been pledging, talking about a lot of push when it comes to infrastructure projects coming in from the government itself, whether it is in space of auto or electric equipments, and that's exactly where silver usage will go higher. The global silver industrial demand in 2025 is expected to be at record highs. This would be a 4th straight year of industrial demand hitting record numbers in the global markets there. Also, the global gold and silver ratio Fundamentals are in case of supply and demand numbers as well. 2025 is the fifth straight year of deficit in the global markets there. The street is also looking at demand and supply numbers for this year, which are on the positive side. So when you look at the demand, it's expected at 1.20 billion ounces, while supply is at 1.05. And there's no carry forward from last year because this is the fifth straight year of deficit, and that clearly is giving support to silver prices there. Also, when you look at the ranges that the silver has put in, you can see it's on the higher highs. In 2023, $19 to $27 an ounce of a silver range is what we saw. It gained up to 22 to 35 in the previous year. And in this year until now, we've seen a higher range of around 29.5 to 39.5 or thereabouts for this year, with Street anticipating that you could be looking at higher highs going forward. And that's exactly what most of the banks and brokerages seem to be putting out. From JP Morgan to Bank of America to UBS, $39 to $40 an ounce is an expectation of an average silver price for 2025. And that just continues because when you look at the other banks like Citi, Stancy and Saxo Bank, they're also talking about 40. We're not too far away from there, but 40 of an average is what they're talking about. So if we've done 29 and 39 is where we're trading at right now, markets do believe that you could be looking at 42, 45 on the higher side before this year ends.
Okay, so silver continuing to sparkle and shine. Thanks for that, Manisha. Well, with that, we're coming back to the equity market. The mid-cap correction is now well entrenched. The mid-cap index is down about 0.5%. The Nifty is holding on to gains of about 35 odd points now. So we've cooled off from the opening highs. Onto some stocks. Vinny is tracking Orient this morning. Stocks under a bit of pressure. Vinny, what's happening?
Hi, good morning. So this is coming in after their earnings that were reported late last night. Now, when you're looking at it, the Q1 FY26 number on a quarter-on-quarter basis, revenue has just seen a growth of 3%. Profits are up marginally by 2%, while margins have remained almost flattish at 20.3% this time versus 20.2% in the last quarter. This is the EBITDA margin I'm talking about. They've added 16 new clients. But what is the factor that comes into play? Sequentially, when you're looking at this 3% growth rate, that is one of the lowest growth rates that the company has seen, or the slowest growth that the company has seen in almost 2 years. And on a year-on-year basis also, the growth is just coming in at around 28.7% for Q1 FY26 versus Q1 FY25. So that growth is also significantly lower. And the last time we'd seen such slow growth rate for the company was somewhere in September 2022 on a year-on-year basis. Now, when last we spoke to the management as well, they'd given a growth guidance of 30% CAGR growth for FY26, full year growth. Now, clearly, 28.7% is slightly below that. So that is a bit of a concern. But in the press release, the management has highlighted that, they are on course to meet that full year growth guidance. But we'll have to wait out for more factors coming in from them in terms of banking. How is that doing for the company, as well as the tech segments? These are important for the company. As of now, a weak number coming in at least on the top line front. PAT margins are in line with their guidance that they're given.
Okay, all right, Vinny, got it. Thank you very much for the details over there. With that, we do have to take a very quick break. Coming back on the other side, Lata will be in conversation with Santanu Chakrabarti of BNP Paribas on the Q1 banking results we've seen so far.
Welcome back. We are still tracking results, banking results in the first quarter. So far, both public and private sector have largely been above market estimates. ICICI at one end has, of course, been exceptional, while Axis Bank disappointed with higher slippages, albeit technical, they called it. But are the numbers all priced in? And how will the rest of the year pan out? Joining me, Shantanu Chakrabarti, India analyst, BFSI at BNP Paribas. Good morning, Shantanu. Thank you very much indeed for joining us. Well, you know, your best pick is HDFC Bank. I would have thought, going by the results, ICICI Bank with margins, which is about 70 basis points higher than HDFC Bank's, would steal the cake. But anyway, let's go one by one. HDFC Bank, what makes you so confident that the mean will revert and they will come back to that near 4% margins?
Right. Good morning, Lata. First of all, it's a pleasure to be here. And you're right. I mean, if I have to name a leader in the entire banking pack today, I think the baton has arguably changed hands from HDFC to ICICI a while back. Some of it may not be within HDFC's control. After all, when you get a full, large wholesale liability franchise merged into you, your liability strengths on a percentage basis do not remain what they were. My argument in HDFC Bank rests on the simple premise that there are certain new realities with the new balance sheet, which is basically that fundamentally this is now going to be a lower margin business. But at the same time, thanks to the scale that comes in, it is also going to be a lower operating cost business. And finally, within the next 2 years, you will see exit ROAs and ROEs converge with its pre-merger levels of 2% and 17% respectively, which should drive the full re-rating. In fact, the anticipation of the same or visibility of the same should be enough to drive the re-rating back to something, if not the older multiples, something fairly north of where things stand today.
Okay. Having said that's very important. Yeah, sorry, go ahead. Sorry.
I said that having said that, I have, no reservation in calling out that as of today, on landed cost of liabilities, even adjusted for scale and operating cost, etc., ICICI has a clear edge over everybody else. It has the greatest privilege in banking, which is the ability to pick and choose the risks that you want because you have a cost edge. As far as HDFC Bank's results go, frankly, Lata, I think post the results, markets have probably treated the bank stock a little better than I would have expected it to. Because on margins, just you were pointing out, ICICI's margin performance. Quarter on quarter, the dip for HDFC Bank was a little sharper than most people expected, right? I mean, it's not a deal breaker in terms of a long-term thesis, but the immediate reaction being positive despite that is something which is quite interesting.
Okay. No, I agree with you. I think everyone is believing what you are saying, that even if the margins don't come back to the 4% plus, they will manage on ROE because of other reasons. But even the ROE is about 14.5, isn't it?
Right.
Compared to, I think, ICICI 16 plus, almost 17. So by when do you think HDFC Bank gets to its old ROE? Is that happening end FY26, exit of this year? Is it happening exit FY27?
Right. So, Lata, to answer that question, the first thing we have to keep in mind is the amount of legacy liabilities which are high cost, which they have inherited from their erstwhile parent. This comes in two primary sources. One is the non-convertible debentures, which HDFC had issued. On that, the expiry schedule is available with us. And therefore, we know we have about 1,90,000 crore kind of numbers still outstanding at about 8%. And similarly, there's, of course, term deposits, which have been grandfathered in from the erstwhile parent, which would also be typically at 50 basis point, 25 to 50 basis point higher costs than what HDFC's equivalent cohort would be. So both of these, I think the expiry schedule on both of these ensures that on a secular basis over the next 7-8 quarters, each quarter HDFC Bank has an incremental tailwind of 2-3 basis points building up sequentially every quarter on margins. Now, that may not sound like much on a per quarter basis, But if you add up, it adds up to almost 15 to 20 basis point of margin tailwind over a 2-year period. Now, other than that, there are, of course, cyclical factors at play. Please understand that if I calculate CASA as a percentage of total liabilities instead of deposits, HDFC Bank's CASA today is below 30%, right? So, and of course, there's a CASA engine out there, which even though in the last year has been outshone by ICICI Bank, in the 3 previous years before that has done a fantastic job of shoring up whatever little was available in the system. So from that point of view, as the easing continues and low-cost funds become more and more available, HDFC Bank should be in a good position to take advantage of that. And I think in management commentary also, you can see allusions to that factor. When management is saying that, that we are basically now willing to accelerate in the first stage, bringing it to 95% credit deposit ratio and mobilizing money was the key, while now we become more selective, more aggressive, better cross-sell to clients and so on and so forth. Now, obviously, they have the machinery to get that done. So I think, they remain a very counterintuitive beneficiary of easing, even though they are 70% floating rate assets.
Okay. Yeah, we are forgetting that even if you look on a year-on-year basis, that stock has given about 15% returns. It was around 1,700 same time last year. So it's a fairly decent return in terms of stock price as well. Obviously, most people believing what you are saying, that the ROE will come in good time. Now, I have a more general question before I delve into the specific of Axis and ICICI. Do you think that the banking system or banking investors are not prepared for a much lower credit growth? The credit growth numbers, fortnightly numbers, are still single digit. Now, is it likely to remain that way for the rest of the year, given that credit offtake is... most bankers are telling you credit offtake is not happening.
So, Latha, the way I look at this is that whether any future rate cuts pan out or not, simply from the amount of liquidity available and the soft indicators that RBI is putting out, the subtle change in tone that you see in commentary of the banks, where they are saying, we are well poised for growth, etc. I think we are at the cusp of a small growth acceleration, but let's keep that in context. I'm not saying that we are going to go back to 17-18% credit growth. I think we exit this financial year with about 13% credit growth, which is still almost 300-350 basis point acceleration over where things stand today. Now, what gives me that hope? This quarter was the last quarter where a high disbursement number was in the base for retail loans. The next 3 quarters of the financial year actually have low disbursement numbers for retail loans, mainly because of the pullback that happened within unsecured loans and credit cards in this corresponding period last year. So I think for the full year, the banking system should be able to deliver 14 to 15% credit growth in retail. Just from normalization, not from going back to the gung-ho days of 25 to 30% growth in, personal loans. I'm just talking of a normalization. We, of course, remain constructive on the SME sector, and their 17 to 19% kind of growth seems to be holding on very well. The only laggard is going to be the corporate sector, in our opinion. I'm sure, the 101 arguments can be made as to why, it's just right at the cusp of an acceleration, etc. But I think given where the global macros are, if you talk to most promoters in India, very few people have the appetite to be jumping into large projects with long-term bank financing right now, especially when, a lot of foreign financing in the debt markets is available to them, right? So I think 6-7% corporate loans is what you should be budgeting for the year. But that still gives you a very solid 13%.
Okay.
And since
I agree with your 13% exit, maybe not 13, at least 12, but the average for the year could still be single digit is what everyone, every banker after banker tells me, we have money, but whom do we lend it to? That seems to be their problem. But anyway, we are running out of time. Axis, is this the last of the accidents? This came out of nowhere. would you still, you're still betting the house on Axis. Where does this confidence come from? Even the loan growth has been muted.
Right. So, I mean, Axis has disappointed continuously for the last 4-5 quarters by small measures, which is why the hope has not died, but it has been frustrated again and again and again. So firstly, let me highlight what are the two things working in its favor. One is, of course, the valuations. If anything's trading at 1.6 times 1 year forward, and it's a 40% CASA bank, which still can do mid-teens ROE, without huffing and puffing too much in terms of what risks it takes, it looks like good risk reward. Second is on the liability side, given the degree of short-term funding that they have available, they remain one of the early responders on cost of funds as far as an easing cycle is concerned. That's what's working in its favor. What's not working in its favor is ever since the merger and having digested the merger, in the last, especially in the second half of the last financial year and this year, headline growth numbers, whether they be on deposits, on loans, on low-cost deposits, that is CASA, it's been a bit of a disappointment. And there's just no squaring that circle. Even on credit costs, I will take you back to first quarter of the last financial year when the first spike happened. And they had, they didn't call it technical, but they said specific assets, we had to do some recognition. And, large part of it, they implied that it's going to get clawed back. But adjusted for, what happened with NARCL in the last quarter, where they got a release purely because of, change in regulation.
Yeah.
Otherwise, the true credit costs have averaged at about 83 to 85 basis points, right? Which is significantly higher than where the other large banks are posting. And they are talking of a retail asset cycle in a period where others see it normalizing, the minor cycle we have had in the last year. So, yeah, it's been frustrating, but I still think it is one of the better options for beta. Is it as at high in our pecking order as HDFC and ICICI? No. But it is one of the smarter beta plays, especially in a situation where, IndusInd Bank in itself is a harder buy for most people, given, the uncertainties around the name.
Okay. Yeah, if one is perhaps looking at a beta, then maybe Axis has a better chance, but still you are looking at an almost 40-45% jump from the current 1,100 rupees to 1,600 plus, which is your target. Right. That looked ambitious to me. Actually, I have more questions for you in terms of the MSME loans, but out of time on another day. Shantanu, thank you very much for joining me to analyze the results of the big banks that have reported so far. There are many more to come, especially the big SBI. We'll analyze that as and when. For the moment, a short break and then Chartbust.